Hello everyone, this is John Muntz with Dealer's Edge. I want to welcome you all to our ongoing series of workshop summaries where we take one of our full-length online workshops and produce a shortened video summary of the material provided. We typically host 3 to 4 full-length webinars a month that usually run about an hour's time. In case you haven't heard of us, Dealer's Edge is a firm dedicated to informing dealers and dealership management on topics relevant to your bottom line. We are always producing new content via our online workshops, webinars, manuals, books, and summary. For this summary, we are talking about LIFO, last in, first out inventory reserves, and 2021's unique tax situation with Rob Campbell and Brian Wallace of Witham. Dealer's Edge members have access to the full 1-hour workshop as well as the executive summary in PDF format, which is what is being read here, not to mention hundreds of other topics targeted to dealership owners and managers. Rob Keeley, an industry expert himself, wrote the summary, and the narration is done by Darius Jackson. All relevant links will be in the description below. Please remember to like, comment, and subscribe to stay informed of new releases. So, all that aside, let's get into it.
Dealer's Edge Executive Summary, LIFO Reserves to be Big Issue, 2021 Taxes. The unexpected shortage of chips has, as you know, had a significant impact on new vehicle production and new car inventories. Last in, first out, LIFO elections have traditionally provided a non-cash expense tax deferment strategy for most auto dealers. However, when the inventory shrinks, like it's sure to in 2021, your delayed tax bill might quickly come due. This scarcity-generated record profit creates the tax implication equivalent of the perfect storm when combined with LIFO recapture. This session highlighted the impact of shrinking LIFO reserves on dealer taxes and discusses strategies for mitigating its impact. So what's a dealer to do? Brian Wallace, CPA, and Rob Campbell, Analysis for Witham Accountants and Consultants, joined us to explore how the lack of new car inventory is having a severe impact on dealership LIFO reserves. After a long and successful career as a dealership consultant and trainer, Rob Campbell joined Witham, a full-service accounting and consulting firm, as a dealer analyst, where he uses his background to help his clients improve their operations through better planning and financial review. He has written extensively with 17 books and manuals about fixed operations under his belt. He is a frequent and popular speaker at industry events, including 10 NADA conventions. This report is a summary of his comments and suggestions. The hardest thing to understand is the income tax. Albert Einstein. Who knows if Einstein really said this, but he could be describing the conundrum surrounding LIFO recapture in 2021. In this workshop, Rob and Brian joined us for a frank discussion of what you need to know to mitigate the impact of a 2021 LIFO reduction. The takeaways from this workshop are: not much good news for LIFO dealers this year. Possible methods for mitigating the impact from reduced LIFO reserves. Current lobbying activities of NADA on this subject and the possible results. The perfect storm. Government-mandated shutdowns, supply chain disruptions, and reallocations of resources, such as computer chips, have caused shortages that have severely impacted auto manufacturers' ability to keep up with the demand for new vehicles. Less production has meant lower allocation of new vehicles to dealers, resulting in record low levels of inventory. This limited supply is driving up new vehicle gross profits, with many dealers realizing significant profits. Demand has also increased on used vehicles, driving up prices. The upside of high prices and limited inventory is record gross profits, up over 50% according to NADA. July 2021, 8.7%. July 2020, 5.7%. But cash balances are not the only thing up from these higher profits. Reduced floor plan expense. Tax-exempt Paycheck Protection Program funds that nearly all dealers took advantage of, and other inventory-related expenses are adding to the bottom line as well. LIFO, income without cash. Approximately 40% of new car dealers account for their new vehicle inventory using the LIFO method and have benefited as inflation has driven annual increases to their LIFO reserves, has resulted in lower taxable income. The significant decline in new vehicle inventory quantities will likely cause a significant decline in a dealer's LIFO inventory reserve. On the bright side, the timing beats the last time dealers experienced LIFO reductions during the Great Recession. Bob and Brian offered this dealer's example to set the stage for today's workshop. One dealership's situation. December 31st, 2020. $20 million in new inventory, $2.5 million in LIFO reserve. September 20, 2021. $8.6 million in new inventory. This reduction of inventory produced a forecasted LIFO recapture of $1.4 million and an estimated tax liability of $550,000. Assuming that nothing changes, what options are open for this dealer? Options for mitigation. Include all vehicles in transit for your estimate to lessen the LIFO reserve hit. Use the wholesale statement reconciliation that shows all vehicles invoiced to you but not yet received to increase inventory value. Accurately account for base price inflation. Acquire more inventory. Good luck. For dealers with both LIFO and non-LIFO stores of the same franchise, maybe the allocation can be increased at the LIFO store and reduced for the non-LIFO store. Section 473. NADA is lobbying for this to happen, and it works like this. Treasury has to formally declare that the disruptions that the auto industry is experiencing with the chip shortage is qualified inventory interruption under the provisions of Section 473. Qualified inventory interruption. 2. Qualified inventory interruption defined A. In general, the term qualified inventory interruption means a regulation, request, or interruption described in subparagraph B, but only to the extent provided in the notice published pursuant to subparagraph B. B. Determination by Secretary whenever the Secretary, after consultation with the appropriate federal officers, determines 1. That I. Any Department of Energy regulation or request with respect to energy supplies, or 2. Any embargo, international boycott, or other major foreign trade interruption has made difficult or impossible the replacement during the liquidation year of any class of goods for any class of taxpayers, and 2. That the application of this section to that class of goods and taxpayers is necessary to carry out the process of this section. He shall publish a notice of such determinations in the Federal Register, together with the period to be affected by such notice. If this happens, then dealers will be permitted 3 years to replenish their inventories. So assuming that Section 43 is not invoked by Treasury, what options are there? Sadly, not too many. Best choice of 2 bad options. Take the hit, elect to go off LIFO. This allows for a 4-year recapture of the tax burden. The future of tax rates. When considering options, it is prudent to consider what the tax landscape will look like going forward. The current tax proposals are looking to restore the top tax rate from 37 to 39.6%. For higher income taxpayers, the qualified business income QBI deduction is capped at $500,000. A new 3% tax surcharge on modified adjusted gross income, MAGI, over $5 million for a joint return, half if filing separately. Potential Medicare and net investment income tax adjustments are on the table. C, corporate tax would replace the 21% flat tax with the graduated schedule. 18% on first $400,000. 21% on income up to $5 million. 26.5% thereafter. Brian noted that most dealers are not C corporations, but those that are might investigate converting to an S corporation with their tax advisor. Besides the changes, the Witham team expects some step up in enforcement as well. LIFO recapture. Returning to the example of our earlier dealer, what would their recapture look like? Dealer with $2.5 million LIFO reserve is at 43% of their 12/31/20 inventory. Option 1. They could take the $1.4 million income hit and a tax liability at the effective federal rate with QBI, etc. of 29.6%. Option 2. They could elect off LIFO and only recapture $625,000 at this year's rate and the remaining 3 payments at whatever rate is in effect on those years. Option 3. Take the big hit this year while taxes are low and cash is available, then opt out. In this example, by waiting a year to come off LIFO, the dealer would save almost $100,000 over versus option 2 over 4 years. Conclusion. While LIFO tax implications might be painful this year, Rob stressed that it represents repayment of deferred expenses from previous years. When asked whether a non-LIFO dealer with a low vehicle inventory might benefit from going on LIFO, both Rob and Brian answered yes, depending on what the dealer's future plans are.
Okay, that's going to do it. Again, this was just a summary of the material provided. The full workshop goes into much more detail. Please check out Brian and Rob at witham.com. Our writer Rob Keeley's info can be found at fixedopsolutions360.com. And to look into becoming a Dealer's Edge member, it's dealersedge.com/VIP. Please don't forget to subscribe as we have many more summaries on the way. This is John Mutz with Dealer's Edge saying goodbye for now.